You're listening to In Good Company, a podcast for business owners who know the best ideas don't come from textbooks, they come from real conversations. Being a business owner can be incredibly rewarding and sometimes incredibly lonely. This podcast was created to change that. Through real conversations and shared experiences, In Good Company, hosted by Connecticut Wealth Management, connects business owners navigating growth, leadership, and everything in between. Because business is better when you're in good company.
All right. Hello and welcome to In Good Company. This is our podcast here at Connecticut Wealth Management, where what we're trying to do is create a community of business owners and those folks that service business owners, trying to help each other get through issues, challenges, face opportunities, really trying to create almost like a club-like environment where all of these business owners can work together so we all find success. Today, we're going to talk about something that we talk about quite a bit with our clients, and that's exit. And the phrase we use around here is that exit is inevitable. You will exit your business. Everyone will exit their business, but it would be nice if you could actually do so with a plan. So unfortunately, a lot of folks exit their business without a plan. Unpredictably, maybe it's death, maybe it's divorce, maybe it's disability, could be a whole bunch of things. But the other thing that we like to talk about is how do you plan for an exit either internally to family members, management, et cetera, or externally. Today, we're going to talk about that external exit and an external exit through sale. And we have an awesome guest today, Ramsey Goodrich from Morse and Goodrich, is here to talk to us about what that looks like, how it feels, things to consider. So I want to welcome Ramsey. Ramsey, thanks for being here.
Absolutely. Thank you for having me.
So Ramsey, why don't you start off with the Ramsey Goodrich story? Tell us about Morse and Goodrich. Tell us about the firm, what you guys do. Tell us about your story and your background and how you got to this role.
Excellent. Well, thank you. And I'm thrilled to be here. And we love talking to business owners about what is the most important thing that they can think about, which is we try not to use the word exit, but rather a transition, whether it be succession planning, whether it be a partnership with a private equity, whether it be a sale to somebody else, whether it be some other solution. But that transition is so critically important going forward. But Morse and Goodrich, we are a boutique investment bank headquartered here in Southport, Connecticut, but offices in Providence, Rhode Island, and as of June 1st, Garden City, Long Island. So we're expanding throughout New England. We really specialize in only representing families and founders in their once-in-a-lifetime transaction. My background, to answer your question, was more on Wall Street. I started out at JP Chase doing cross-border deals, mega deals, went to Bank Paribas. I left a big bureaucratic bank for a bigger, more bureaucratic French bank, and then joined Ernst & Young right before the bubble. Now for those next generation that don't know what the bubble is, I'm talking about the 2000, 2001 technology bubble, where it was great M&A on the way up, great restructuring on the way back, down, and frankly, the birth of private equity. And so I was lucky enough to run the financial sponsors group there for a number of years with a great team across the country and did some really fun stuff, but realized that my heart was still on families and founders and really making sure that we did that. Flipping a private equity portfolio company to another private equity fund is not that exciting. But when you get something that's so special and unique and important in somebody's life, it really helps to have that passion behind it. So we only do deals in 5 old economy businesses. So really our core bread and butter is manufacturing. We do business services, food and beverage, consumer products, and believe it or not, HVAC. HVAC right now happens to be really hot. Or is it a really cool industry? I don't know. I'll let you determine which way that goes, but really exciting industry to be in right now. So in that core middle market, while our marketing material says 25 to 250 in terms of enterprise value, our real sweet spot is in that 50 to 150, a key transition point from owner-led and really truly professional businesses. So,
awesome. So when you have a business owner that comes to you, and we'll talk about when they should come to you, but when you have a business owner come to you thinking about selling their business, aside from sale price, sale value, what what do you think is the most important thing that business owner is actually trying to accomplish? Usually, what are they actually trying to accomplish?
Well, you said it perfectly. Everyone's concerned about maximizing value. Get me more. Of course, that's how we're incentivized and everything else. The only measurable definition of success is purchase price, right? How much? The problem is it's usually the wrong metric to use. When we sit down with business owners and we figure out what we're thinking and how the valuation of the business is, there's still so much more to learn, so we have a decent estimate of what we think we can get. But that's only the start of the story. The most important thing is, what does that owner really want to do? What's the definition of success? And we use not transaction, but transition. Most owners think of the conversation as being very binary. I either own 100%, run 100%, make 100% of the decisions, spend 100% of my time, or I'm out. And both of those are not true. And so, well, it may feel like the first one is true. And so it's really about what the definition of success is, about what do you want to do post-transaction. We use a fun analogy that if you're going to sell the business on Friday, you're going to party like a rock star all weekend. That's great. What do you want to do Monday and the following Monday and the Monday after that? And that sort of changes people's thinking a lot. Valuation, you're right, always the key determinant, only definition of success, tangible definition of success, but there's so much more to it. And so it's really about what is that transition to something else.
When you talk to business owners about what they might want to do on Monday, and my guess is, and we'll talk about this too, but you're working with a business owner for years.
Yes.
When you talk
Ideally.
to them, ideally, that would be the perfect scenario. If you're talking to them today, what they think they want to be doing on Monday, and then in 3 or 4 years when they actually get to market, does their decision about what they want to do on Monday change? And how do you find out what they actually want to do on Monday? What's that process like?
That's the hard part. That's the art of the deal, not the science. When we start talking about it, it really is transitioning to something else. I want to retire. I want to spend more time with my grandkids. I don't want to do it anymore. I'm burnt out. My wife finally won the argument. Whatever the definition is, to instigate the conversation. But you really don't understand what that outcome's going to be until you're down to the last few potential partners. Well, again, here's a vernacular difference. Most people refer to a buyer. Well, the buyer implies the end of something and the beginning of something else, or an investor. But an investor simply implies a financial transaction. But we talk about who's the right partner for the company going further. We'll talk more about that. But when you're talking about the next partner, what we find is most owners actually get really excited about staying with the business post-closing because they found the right partnership. Remember, once you get past the money, and once you figure out what I want to do personally, there's a huge emphasis on legacy. I built this company for decades, if not generations, if not eons. We recently worked with a 6th-generation company that had celebrated its 150th anniversary. That's a really big decision, and they were more concerned about their legacy, their reputation, who they were as a family, more than anything else, to their employees, to their customers, to their community. And so that legacy becomes super, super important as you think about it. So what do they want to do post-closing on that Monday, coming back to your question, really depends on who the partner is. Again, tell me what the definition of success is, and then we can customize the outcome. But we do see that owners get real excited to stay with the business, but maybe in a different capacity. Right now, if we go to the first scenario, 100% of the decisions, 100% of the time, maybe I get elevated to a board level. Maybe I'm a consultant. Maybe I just run I want to go tinker in the back office. I want to do new product development because that's how I started the business. Maybe I want to make acquisitions. Maybe I want to run sales without the burden of HR and administrators and everything else. And so I think it's not a simple answer.
Ramsey, you talk about it being a long process. You talk about people having, a definition of success. Does that definition change as you get to know them, as they talk through this more, as they explore it, maybe with whoever it is, their family, their co-owners, their management team, whoever it is that they talk this through? Are they clear in the beginning? If they look back 6 months, 2 years, whatever it is into it, and look back to what they originally said, how they talked about this, what they thought was their definition of success, does that hold true through the process?
Usually pretty close. It's never 100% accurate at the beginning, but at least it's a starting point to engage in the dialogue and consider options, right? We often have business owners saying, I got a knock on the door, they gave me a stupid price, I'm going to sell. Well, you haven't thought about it yet. What does that actually mean? What do you want out of this? And yes, money might be attractive, but you never know from the first deal or from the first offer. But a lot of times when we sit with management and the owners, they say, well, I'll do whatever the buyer wants me to do post-closing. Wrong answer. Tell me what you want out of it, and then we'll go find the right partner. But if they want to fire me, they can. No, you don't really mean that. And so we really challenge a lot of those assumptions up front to make sure that we have that definition before we even make a phone call or design the plan. But usually there's something bigger out there. It might be age, it might be a health thing, it might be a family thing, it might be I'm just exhausted. We are seeing, and I think the number one issue that we're seeing right now is a multi-generational issue, which is the kids don't want the business. I built this family business to pass down for generations. I've come down 2, 3, 4 generations, or I started this and I want to hand it to my kids, and they don't want it. They don't want to be on the factory floor. It's not sexy. It might make a ton more money than being an internet influencer or a lawyer or a doctor, but it's not sexy. For some people, I think it is, but that's a different issue. And so I think what we're seeing is that generational thing is I'm getting old enough, I want to spend some quality time with my family while I can, and I'm healthy and I've got enough money to do so, but my kids don't want it. My management team's probably not ready to step up or don't have the money. I really got to figure this out. And that's where, guys, the planning starts. And that should start years in advance. And so the instigation is usually the same, Kevin, but the outcome is always a little bit different.
Are you seeing more family-owned businesses not going to the family? Like, is that interfamily transition,
Yep.
the percentage of deals shrinking?
Yep.
It is.
And it's just, well, statistically speaking, going down to the next generation is actually harder and harder each generation.
Yeah.
If you look at it goes from father to son or to the next generation, G2, G3 is infinitesimally smaller than that, and G4 is nearly never happens. If you look sort of, I could spend a lot of time on sort of the bigger macro picture. When the greatest generation came back from the war and started building their companies, the next generation, baby boomers, took over their businesses, and now the third generation is really the challenge because they all want to do white collar professionals jobs. So more than that, but we're also seeing right now what I nickname the silver tsunami. We are going to have, we predict, a tidal wave of deals, but it's not just a tidal wave, it's bigger than that. It's a tsunami wave of deals from folks that have a certain hair color that clearly I don't have. That the silver tsunami of deals is starting to build. We've come out of a period now that, go back even just recently, a couple of years of COVID, then supply chain disruptions, then massive inflation, then a huge interest rate spikes, and then waiting for the election, and then the outcome of the election, and then immigration, and then tariffs, and now the Middle East, and now who knows what's next. So the only thing that's certain today is uncertainty. And so how do you manage your businesses appropriately? What we find in the middle market, it's less volatile. It's less subject to global whims or interest rates or stuff like that. Most of our businesses don't have debt. Who cares what the interest rate is, right? And so it's less about that. It's more about the emotional side of is now the right time.
So Ramsey, could some of those people you're thinking about as you tell that story, is it the circumstances that kind of existential circumstances, or is it internal? Could they have changed the outcome? Could they have spent more time? What we find as many of our clients, the total proportion of our clients has increased to business owners over time, and hence here we are talking about business owner issues, right?
It's funny how that happens.
Yeah, funny how that happens, and as we've grown our business and struggled with the same issues that people do, you need to spend time. You need to be thoughtful and not just, as we say, it's Monday and we're trying to get to Tuesday. We've got to think about Friday and next Friday and 365 days from now, et cetera, et cetera. I guess again back to my long-winded question: could people have changed the outcome if they really wanted it to pass along to the next generation, or if they really wanted to sell it to, internally to a management team?
Absolutely. Again, start with what's the definition of success. There's the balance between liquidity, proceeds, from a sale or from a private equity partnership versus passing it down to the family member where there's really no liquidity event. So it starts with what the need is. With letting your management team, well, altruistic, probably is a lower valuation that you would get from a market. So tell me what the objectives are, and start A, with what the personal objectives are, but B, what's all the monetary perspectives are. And then 3, what's the altruistic outcome as well. ESOPs for some businesses are great. For the tax advantages could be amazing, but it doesn't fit for everybody. Same thing here. A sale or private equity partnership isn't for everybody. It depends on what the definition of success and what the desired outcome is going to be.
Is it also fair to say, I guess, if you're committing to maintaining a business independently, you're going to build up a management team, maybe spend more time and energy and, frankly, money on that management team. Is it also fair to say that if you change your plans, that is likely to bring more value to an outside buyer, to have a well-oiled machine, to have a management team that's operating independent of the founder?
Absolutely. Your management team is the best prediction of value. People don't buy businesses for their assets or their brand name or anything else. They invest in businesses for the people, for the management team that are getting it done, the ambitious next bench down. One of the biggest risks we see in family businesses or founder-led businesses is the concentration in that owner, right? Value is the inverse of risk. The more risky the business it is, the less I can pay for it. So if you look at that highly concentrated owner that's making 100% of the decisions all the time, that's really risky for not only the operating company, but for the next partner as well. What happens if that owner gets hit by a bus? Or we don't say that anymore because we actually did have a client get hit by a car. So we'll call it abducted by aliens. So when you look at that, if that concentration of all of that knowledge and all that power and all that decision making disappears the next day, it's really risky. So I can't do it. So the best way to transition the business, whether that be to your family, to an ESOP, to management, to a private equity guy, to a fundless sponsor, to a family, blah, 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 whomever you think, investing in your management is by far the best investment you can ever make. The flip side of that, and I tell a funny anecdote here. One of my biggest recommendations for family businesses: fire your brother-in-law. Nobody likes him anyway. He's just a dead weight. You're just handing that problem on to the next guy, and you're making it his problem. And what am I going to do? What's the next guy going to do? He's going to fire him anyway. So here's where the math works and where it's kind of fun. Pay him an exorbitant amount of money to go away. Make Thanksgiving happy, but agree that he's not great at the company, and so pay him an exorbitant amount of money to go away. Thanksgiving saved. He's off to his next adventure. He starts his new business. He's out of your life. Fantastic. Now his salary now becomes an add back. So let's say you were paying $200,000 a year, pay him $1 million to go away. Well, that's 5x. If you sell the business for 7 or 8, 9, 10x, you've now, because he's an add back and didn't add value, you add that back to profitability times your market multiple. You've just made an arbitrage by firing your brother-in-law. He's happy, you're happy, your sister's happy, mom and dad are happy, kids are thrilled, your management team's thrilled. Oh my God, the best investment you can make is firing your brother-in-law.
So, Ramsey, let me ask you about the opposite case. I'm curious how you feel about this. And maybe, certainly in smaller companies, oftentimes we hear people say something like, "Oh, we know we need, we probably should have a CFO, but we can't afford that. It's too costly." Thinking about it as an expense versus an investment, right, in the future. And I think you could use your same methodology and say, boy, by taking on a significant salary, I'm reducing the value of the cut, right? That same multiple, unless that person moves the needle significantly.
Wrong answer. You can't look at everything as an expense. It has to be an investment into your success. Find the right guy, overpay him, and I guarantee that person will add more value. One of our key determinants of the clients that we take on is their willingness to invest in their success. Meaning, have they invested in their management team? Are they going to do a quality of earnings report? We'll talk more at a different podcast of what that is. Upgrading your lawyer, upgrading your management team, spending the time to do the estate planning, spending the time to do the wealth management planning, really investing in making your business successful. And when that happens, the outcomes can be magical.
Hey, Ramsey, you've done hundreds of transactions?
Yep.
Hundreds.
Personally, as a firm, about 450. Personally, about 120. Wow.
So you have tons of stories, which I love. Can you think of a story where a business owner actually did the preparation for departing the business and did a really good job at it?
This is going to sound really self-fulfilling. It's not meant to be. Most of our clients. Because we really do sit back and wait and say, okay, are we ready to go? Most business owners are concerned, how quickly can you get me into the market? How quickly can you get me an offer? The problem is then you're sprinting to the starting line. And what happens is as you move towards closing, you trip on the way to the finish line. And that doesn't feel good for anybody. And so doing that, and then when you sit at closing and you've got your Connecticut Wealth Management pen in your hand and you're signing hundreds of pages of documents, is your hand shaking like, oh my God, am I doing the right thing? That's where you have, do I have enough money? Is this the right partner? Have I really thought about it yet? Is my family ready for this? Is my management team ready for this? If your hand is shaking, don't do the deal, no matter how much money it is, because you're going to regret it later. Statistically speaking, most business owners regret selling their businesses. For our clients, because we spend so much time with them on the planning and the preparation, we tiptoe to the starting line. We take our time, and it could be months, it could be years. One of the best outcomes we had was for a fifth-generation family business. We spent 13 years cultivating that relationship and helping them think through multi-generational issues, making a couple of acquisitions, streamlining the operations, having a strategic vision before we ever went to market. We had another guy that we had been working with for a while. Dad always said no, but I get calls from the kids saying, hey, can we go? Finally, I get a phone call one Wednesday. He said, Dad said yes. Well, what do you mean he said yes? He said, we can sell the business. Let's go. How quickly can we go? So there's so much emotion in that one. But the planning and preparation and really thinking about what the outcome is more critical than that. That is the best determinant of success over anything else.
Dennis, did you or did you not write down sprinting to the starting line?
Don't sprint to the starting line, tiptoe to the starting line.
Okay. And then sprint to the finish. As soon as you make that first phone call, game on. Yeah. How quickly can you close? Because time is not your friend. But really think about planning and preparing the due diligence, the personal plan, the trust and estates planning, the wealth management planning, your management plan. There's so many pieces that need to fall into place for a successful transaction. So But once that's in place, as soon as you make that first phone call, sprint to the finish line.
Now, so there are so many unsolicited offers happening right now. People get emails, phone calls, texts from random sources every day. People who haven't considered selling their business, all of a sudden they get a phone call. And when does it make sense to actually engage with an investment banker like you? First of all, should they be taking those calls and those emails and those texts? Should they be responding, or should they be ignoring them? And when does it make sense to engage an investment banker like yourself?
What a brilliant question.
Well, thank you.
Yeah. The short answer is keep a file of them, because you never know. 99% of them are worthless. They're AI generated. I get probably 7 or 8 a day of, hey, we've got a guy who wants to buy your business. We're an investment banker. Hire us. Like, do you not know what I do for a living? So 99% of them are AI generated, and you can throw them out the window. But every now and again, there is something really weird, or really unique about either the approach or the compelling rationale. Keep a file of those. I wouldn't necessarily engage, but because then it goes back to testing the market, which we don't want to do. But keep a file of those. If they're interesting and they've proven an interest in you, put them on your short list, because then it's a higher predictor of success. But you've got to go back and answer that question, why? What is it that I'm looking out of this? To be knocked on the door is incredible flattery. And I love it. Oh my God, my business is worth so much. And everybody wants me. Right, until they dig into the details and find the ugly stuff, and you haven't fired your brother-in-law yet. And so it really is, keep a file of them. Don't necessarily engage. And my number one rule of all time, do not send anybody your financials. Everyone starts the conversation and says, oh, just send me your financials. Yeah. Do not do that. Every business owner on the planet, including us, including you, manages our income statement to potentially avoid paying too much in tax, right? So lower income is not the basis you want to go into an M&A transaction for. You want the highest one. So by sending them your tax basis of accounting is not going to do the great things for you. So, and we're guaranteed to be a mediocre offer. The second side of that is just because somebody knocks on your door, when we go to market, and we generally go to 50 to 100 potential partners. Out of that, we'll probably get 10 to 12 to 15 offers. Out of that 10 to 12 to 15, you've got an incredible range of values. We have one transaction right now. The low bidder was exactly half of the high bidder. We normally see a 20, 30% spread from low to high, but this is 100% difference between low to high. When you look at that and you go back to reflect on the knock on the door and you got an offer, it seems attractive, prove to me where it is on that spectrum. Is that the low offer? Is that the high offer? Is it in the middle? You don't know. So that's where you say, take that interest and say, thank you very much. Go back and figure out, is this the right time for me to do this and why? And then engage the team. Start with your wealth manager and trust and estates planning. Bring in the accountants and the investment banker next, and then the lawyer comes in and cleans it all up.
Ramsey, when is it too early? Right?
Never.
If I think, okay, 5
Sorry.
years from now, 10 years from now. Yeah. Is it truly, right? There's always, I got to imagine, someone that does as many transactions as you and your team does. You're always going to have some advice on I imagine, on how they could improve things, how they could better prepare. Is that fair?
If you talk to any entrepreneur coach, any guy who's starting a new business, any guy that's really thinking about why you're running a business, it should be designed to sell. Doesn't mean you have to sell, but you should be ready to go at any time. Talk to any entrepreneur, they're like, yeah, I'm building this company to sell it in a few years. Well, so how early is too early? Well, arguably it's already too late because you haven't started when you founded the business. And so give it some real time, give it some real effort. Middle market, it's not as volatile as public markets to say, I need to get out right now. It usually isn't true. We actually advise more people to delay going to market than we encourage going to market. We have probably a pipeline of 10, 15, 20 companies right now that are, okay, go fix this, and then we'll come back, or go address that issue, or mitigate this risk, and say, well, wait until you're ready to go, and then we'll try. But to rush to market because some guy knocked on the door, or because you had a bad day at the office, wrong answer. Really think about it and be disciplined in your approach, and make that commitment to your success.
Awesome.
Yeah, that unsolicited offer that you take the call. I always like to remind business owners, like, gosh, he was so nice. He was so charming, and I really felt connected to him. Yeah, because he's a salesperson.
Because he's a professional doing this. Absolutely.
Yeah.
That is his job.
That's his job,
Right.
is to lure you in. And that doesn't mean that the buying firm, is going to be a good fit for you, just because the guy's fun to have a cocktail with, or
Yep.
a good stick on the course.
And because you think it's an okay offer, doesn't mean it is.
Yeah.
It's a starting point. If they don't know, again, this is where planning, preparation, discipline process yields a better outcome. If he goes in and you say, well, yeah, I'm 50 million in revenue, doing 5 in EBITDA, he's going to say, great, I'm going to pay you 6 times. Oh, 30 million bucks. Yeah, that sounds pretty good. Let's go. You haven't addressed any of the risks. You haven't discussed any of the opportunities. You haven't redone your financial statements to say it's really $7.5 million of EBITDA. You haven't hired me to go get it to a 7 or 8x, right? And so there's just doing it in a vacuum doesn't make any sense.
What defines a smooth, and I'm sorry to use the term deal, but what makes a deal go smoothly versus a deal going difficultly?
Yep. Couple of ways to answer that. First and foremost, the biggest predictor is a real commitment to really, honestly, truly wanting to do it. Most business owners, we were talking the other day about, hey, when should I test the market? Don't ever test the market, because it's a fool's errand, and it never works out. You need 3 things for a really successful transaction. Number 1, the owner's got to be ready. Testing the market is not a prediction of if the owner's ready, right? It's meaningless at the end of the day. No buyer's really going to have enough information to make an informed decision, so they're going to tell you what you want, right? Great. 2, you need the business to be ready. Do you have the right management team, systems, data, everything to get through a transaction? And number 3 is the market ready. So testing the market only tests 1 out of the 3 critical components. So what we love to see is a real commitment, said, yep, I really want to do that. We love motivated owners, because there's something better on the other side. And so having that real commitment and real motivation towards a successful transaction, and be willing to invest in that success, really makes a huge difference. Number 2, the best deal is well prepared, well planned. We keep coming back to those same vernaculars. What does that really mean? Number 1 is the wealth management plan. Is it enough? And can I achieve all of my life goals to be able to do that? And then preparation is really the second piece, is can I get ahead of all the due diligence items? You know there's risks in your business. You know you have vulnerabilities. Clean up as much as you can. You don't have to clean up everything. We'll structure around some stuff, but really get ready for the enduring process that's coming. And then third, the third best predictor is really looking at having a great team of advisors. M&A is a team sport. Nobody can do it on their own. Even when you're planning and preparing for this, as we like to say, you need the core 4. You need 4 key people in the room, in your backfield, if you will. Number 1 is wealth managers. Is this enough? How am I structuring? How am I looking at trust and estates? Am I taking care of the kids? Am I taking care of my community? Are you taking care of my philanthropies? Number 2 is a really good accounting firm to look at the number crunching side of things. How do I recast my profitability? How do I look at growth initiatives? Look at my add backs and adjustments to maximize value, and look at the tax side of things. How can I structure this for the best tax after tax proceeds? Who cares what the marquee number is? What I put in the bank is the one that matters. Number 3 is an M&A attorney, the best one you can get. Dentists and brain surgeons both use a drill. They both went to medical school. They both experts in their field. They both have 5-star reviews from all of their customers. They're both friends of friends, and so you can trust them, right? Would you ever trust a dentist to do brain surgery? Don't use your divorce attorney to do your M&A deal, right? Go get the right guy on the thing. And this is completely self-serving, but here it comes. A really good investment banker that understands what you're trying to do. Industry focus is important, but it's not everything. It's who's going to have your best interest at heart, who's going to give you real advice and real outcomes. So not just the industry, who did the last deal. A lot of times we get into a pitch and they'll say, well, how well do you know the buyer? We're really proud to say this, ready? Out of the 450 deals that we've done at Carter Morse, we have never sold 2 companies to the same buyer. Having the relationship with the buyer is an irrelevant and hopefully less disastrous relationship, because then who are you really working for? Right. The guy that buys all your companies? Or am I working for the client to say I'm looking for the best outcome? But think about that for a minute. We only do a narrow sliver of industry, 450 different buyers for 450 different engagements. So get the right investment banker that has your objectives in mind.
Hey, Ramsey, go back if you could a little bit, just relative to the management team. How, due diligence, you an owner, a founder, a CEO can't possibly keep this to him or herself entirely, right?
Many try.
Yeah. Talk about that a little bit. I guess how the management team is involved or not involved, and how important they are to this whole process.
Yeah, management's critical at the end of the day, and it's always that balance of when do you bring them in. It is, once you've made the decision to pursue a transaction, it is the second scariest conversation to have. Bringing your management team under the tent. It's really hard. It's really emotional. But it can be well scripted, well planned, well prepared. And so what we generally recommend is, first and foremost, M&A is really hard. It's a second full-time job for over a year. While with all the planning and the preparation and everything else, it's a second full-time job just to make sure you have a successful exit. So therefore, what are you really looking to do? You've got to bring in your management team to help. We, as investment bankers, are trying to learn about the business to better position it, to write our marketing documents, to be able to talk to investors or partners. And we've got to have a pretty granular view of the world. I can't get that from one person. He has his myopic view of what's right, wrong, or different. It's amazing when we bring in management under the tent, all of a sudden the head of ops has a really different idea of what's going on the floor than the owner. The head of sales is, I want to go, but the owner won't let me. If I only had X, Y, and Z resource. Finance is saying, well, this is the way we've always done it because the owner won't let me do it right. Okay, well, all of which are valid if I'm 100% owner. Cool, not a big deal. But when we see those perspectives, we can really look at the business differently and help determine who the right partner is. Again, if you go back to valuation is the inverse of risk. So if we can bring in management and prove that there's a good second tier of management, a deep bench, then all of a sudden that risk gets eliminated. And now that management team sees where the opportunities are, knows how to go after them, and just needs permission to go. And a lot of times we throw the going to be less active, I won't say exiting, but going to be less active owner right underneath the bus. That owner's risk profile is really different than a private equity fund, whose job it is to deploy more capital, to hire more people, to make better investments, to make acquisitions. And so the owner is sitting there going, this is my nest egg, this is all I have, I can't afford to take that risk. So it's a different perspective of risk. So if we bring management in and they tell us about all the opportunities, And then we put them in front of that prospective partner and said, oh my God, if it weren't for the damn owner, look at what we could do. Well, that increases value.
So is it? I think I've heard you say this before. To some buyers, it's appealing to have to be less than perfect. That equals opportunity.
Absolutely. We have to be really thoughtful and transparent and vulnerable to admit that maybe our business isn't quite perfect. Why? Because there's so many different type of partners out there. Let's use private equity as the example. Going back to the story, when I ran the financial sponsors group, I actually have the spreadsheet. Hold on a second. Let me pull it up. There's a spreadsheet that was 53 lines long. That is the entire private equity universe for the middle market for our financial sponsor coverage list. I can't believe there's actually a date here, October 9th, 2019.
Wow.
There it is, 53. There are now 6,700 registered private equity funds out there with trillions of dollars to deploy. If you look at this was relationship banking. This is relationship because they were all generalists. Some lean more towards manufacturing than technology, stuff like that. Today, it's a world of specialization. And so that guy who loves manufacturing will never look at a healthcare deal. By the way, the guy who looked at a healthcare deal would never look at a manufacturing. So you've whittled down the universe pretty quickly. When you get down to that narrower range of industry and size and dynamics, now you look at opportunity. If you have a sales problem, don't sell to the operational focused guy who's there to come fix your operations. Go go look at the guy who's going to fix sales. If you have if you want to grow organically and there's enough low-hanging fruit there, don't go to the buy and build guy who wants to do nothing but acquisitions. So you've got to find the right partnership going forward. And so, yeah, being vulnerable about your weaknesses, there's no such thing as a weakness. Only an opportunity for the next guy to do better. And so, Dennis, you can write that one down. That was a pretty good one.
Yeah, got it.
If I think about it.
Dennis has been hearing that his whole life.
So
Sorry, D.
you're not bad. You just have more opportunities than most.
Yeah.
But if you're open to that vulnerability and you're open and really transparent about what the opportunities are, that's where the magic starts to happen, where you find that right partnership. And Kevin, that's where it gets back to, what does the owner want to do post-closing? Oh my God, we could do that? That would be really cool. I'd like to stay.
Yeah.
Right? So it's a self-fulfilling prophecy at the end of the day.
You know, along those lines, Ram, I think a lot of business owners, especially family-owned and founders, have a lot of loyalty to their employees, the team that helped them get there. And there is this, I think there's a fear that, oh my gosh, if I sell our business and someone else takes it over, what are they going to do to our team? Like, are they going to fire everybody? That's got to be a major concern for your business owners. I know it is for ours.
Yep.
How do you work through that? How do you allay their fears that someone's just going to decimate their staff?
It's a false narrative. It is completely false narrative. In the middle market, the deals, if you're buying a multi-billion-dollar company and you can't grow that fast enough to make a really good return, right? You're going to grow at the economy just by definition. In the middle market, there's so much more growth opportunities to do better that people don't. In the 450 deals we've done, certainly the 120 that I've done personally, people invest in management. They give them more resources, more expertise, more specialization, more growth. So it's a false narrative. I have never in my career seen anybody terminated at closing unless they wanted to be. We have had those instances where the seller is not active day to day. We have this situation right now out in Long Island, right there over my shoulder, that the owner said, I haven't been involved in years. Write me a check, I'm gone. And management's going, yes. So that's a planned exit. That's fine. But when it comes to management, It's the exact opposite. Full disclosure, the CFO, if there is somebody that is a CFO title in the company, may be at high risk after a year or two of transition. So that's probably the one area that is at risk, but everything else, we've never seen it happen. If private equity demands much more out of a CFO. Most businesses don't have lending relationships. Now you do. Most have an annual audit or a review that they complete as opposed to monthly and quarterly updates. Most people aren't looking at strategic visions and plans. Private equity live on it. So that CFO role becomes hypercritical, and they usually like to transition to somebody that's there. If you have a controller or a vice president of finance, not a CFO, they're more safe.
Kevin was asking about getting the management team involved. How about the general concept of confidentiality? If you decide I'm going to talk to Ramsey, I'm going to see if we can find a potential suitor, potential partner. You don't want that leaking out there, right? You don't want people talking about that. How do you maintain confidentiality, and what is that risk of having that leak?
So there's risks and there's opportunities. So we're working with a large company out in Denver, Colorado right now, and they were hypersensitive about bringing in their management team. And we, after many discussions over many years, said, look, it's really critical that you bring your management team, your core management team, 4, 5, 6 people max, into under the tent quickly. Couple of things. We get the different perspective, as we've already talked about. But what was even better, our owner, we just put that under letter of intent. We'll be closing that in about 60 days. And the owner said, thank God you convinced me to do that. My management team are finally thinking like owners. They've come up with new ideas. They've come up with new growth initiatives. They've had cost savings. They have operational improvements. They're thinking like owners. Why the hell didn't I bring them in earlier? So there's an upside to bringing in management too, as they're not just an employee, they're part of the solution. But what we recommend is bringing in 3, 4, 5, 6 core level of core management. Usually the head of sales, the head of operations, their CFO, and maybe 1 or 2 others, depending on how your organization is structured. We bring them in really by creating an incentive pool for them, whereby in exchange for giving them a bonus at closing, that they maintain confidentiality, a non-solicit, non-disparagement, negative covenants, so that we structure that so that not only are they incentivized to get to closing, but they're also incentivized to stay for another year. So it benefits the seller because now all of a sudden I know there's going to be this management transition, and they have time to really commit to staying with the new potential partner.
Oh, that's good.
It's great for this buyer or the investor, the partner, because now they know their management team's not going anywhere.
Yeah.
It's the greatest solution of all.
And is that something that you guys would help formulate?
Yep. With counsel. Obviously, it comes with some legal contracts that have to be done. And there is no right answer, because somebody's going to say, well, how much do I need to pay them? There is no right answer. We've seen it as a flat dollar amount. We've seen a percentage of salary, multiple of salary, percentage of the transaction value, whatever feels right and meaningful for that management team.
Is it common, Ramsey, that owners will come, in the beginning, first, second conversation and say, hey, I want to make sure I do something for these folks? Or
almost always.
Got it.
Yeah, almost always.
Do they tend to know what that is in dollars? They just know they want to do something, should do something.
Yep. And we've seen one of the best closing dinners I have ever been to, and it's the worst tax planning of all time. But where we had a welding company down in Georgia, and they're really highly specialized welding, really technical stuff, hard to do. And when we sold that company for a lot more money than the owner thought he would ever see, he brought in all of his core 10 or 12 key guys in the business and said, this is not my business, this was our business. So we have this new partner that's going to take us to new heights, but I couldn't have done it without you. So he brought together his key management team and their spouses. All drove their big-ass pickup truck with all their welding equipment in the back, coming in with their hiking boots, and some of them had the tuxedo T-shirt that because I was dressed up for them. And he said, reach under your chairs. And he had taped a check for $1 million to each one of those welders.
Oh, wow. This wasn't Oprah, was it?
No,
Sounds like
this is, yeah, you get a check, you get a check.
Yeah.
No, it was, but
Wow.
it was one of the most heart-wrenching things to see all these guys that are living in the double wide, living out of their truck, now with $1 million in the bank. About half of them showed up in the new truck next week, but but you look at that, what these owners can do to give back to their team as a thank you for getting us here, and how I'm so excited for the next partnership. We have another one that rolled over. 22 members of management had equity in the company. 22. So when we partnered with a private equity fund on the next recap of that, you ready for this? 47 became owners of the business going forward, and in a not a insignificant way. And so when you have that kind of buy-in and you start thinking about sharing that equity upside, it can become really, really powerful. So that's how you incentivize management.
Cool.
But yeah, it's a heart-wrenching conversation to start. It's usually a glorious result.
I got to imagine if the numbers are big enough, it's easy, and if the numbers are a little tighter relative to maybe what the financial plan shows, maybe it's a little
harder.
challenging. Yeah.
It's what we find though is it's still the right thing to do.
Yeah.
And it really is a thank you for getting me here. Thank you and congratulations on this milestone, and let's set up future success.
Yeah. Ramsey, going back to, I think, you started with really trying to figure out what is the outcome that one is looking for. And I think, Dennis, we probably see this in ourselves. Ramsey, I suppose you might too. Your work becomes your identity to a certain extent. And whether you're a business owner or not, you're an attorney or a physician or, a restaurateur, whatever it might be, you become known as that. How much of that ties in as you talk to these folks, probably looking back at, a long career? How does that factor in? Does it factor in?
Without question. That legacy is critical. We usually find that money's enough, right? We're privileged to work with really successful companies that have been around for generations. Money's not the driving factor, because if you're taking out $10, $15 million a year, you're probably okay, right? It's not a scorecard at the end of the day. And so we come from a slightly different perspective than maybe some of the smaller businesses, but that legacy is still hypercritical. We were working with one manufacturing company here in Connecticut, Northeast Connecticut, where the factory was the town, and the town was the factory, whereby the owner said, my only requirement is you can never move the factory. He said, well, why? It just would make sense, and this is in the middle of nowhere. You can't really find good labor. It's hard to commute here. Shipping expenses are harder here. It's tough to get a truck in the driveway, all this other stuff. And she's like, because my shift supervisor's wife runs the diner next door. Because my controller's husband is the postmaster in town. Because the factory floor worker's wife runs the nail salon. And if this goes away, the town goes away. You will never move this factory.
I think I saw that on Hallmark. I think that was a movie.
Yeah. It feels, but it was real life. It
Right.
really was.
Right.
It was a
And they found a
multi-generational
buyer.
family business, and we found a multinational buyer that needed a footprint in America. And they said, yep, this is great. And we turned down higher offers to realize that outcome.
Does that happen a lot, that they turn down, that you don't take the highest offer?
Don't tell anybody. Okay. So yeah, we can delete
just
this from the
between us.
podcast. Just between us. Okay. Just that.
Mom, don't tell anybody.
That the secret to M&A is nobody takes the highest price. If you have a price of 1, you're going to take it. But if you do your discipline process, you talk to the right partners, and you get to the finish line with 2, 3, 4 potential guys that you want to work with, rarely is at that point is it about price. It's about who's going to do the right thing, what feels right.
Ramsey, we could talk all day. This is awesome stuff. And we are, you talk about the team, how important it is to put together a team. We're super grateful for being part of your team and all the things that you've done for our business owner clients. Seriously, it's an honor to get the chance to work with you. I'm going to ask you one final question as we go. As we say, everyone exits, everyone transitions out of their business. What's the first step that business owners could take right now? If they happen to be watching this and they've stuck around to the end, what's the one thing that you would like a business owner to take away to prepare for that eventuality of them actually leaving the business one day?
Great question. And thank you for preparing me for this question, because I really thought long and hard about it. Be really honest of your assessment of why you're doing the transaction. What is it? Why? Not how, not when, not anything else, but why. Because when you really figure out why, all the other pieces fall into place. Is it because you want to get out? Is it because you want to transition? Is it for the family? Is it for the philanthropy? Again, look at that definition of success and really start with that definition, but understand why, and then make a real commitment to going after it. It may take you still 3-4 years or longer to get to that right outcome. But really understand what is the definition of success.
That's awesome. That's great. Well, thank you so much. This has been really fun. As I said, we could do this all day, but
how the heck did it was that an hour? We're about halfway through our agenda here.
I
so
know.
I'm sorry for talking too much.
No,
that was awesome. Yeah, thank you, Ramsey. You're a gentleman and a scholar, and so truly.
Don't tell anybody. You ruined my reputation. Yeah.
It'll be our secret. Again, nobody's watching.
Nobody's listening anyway. Thanks, Mom. Yeah.
Mom, the handsome man is Ramsey. His name is Ramsey.
Yeah. And no, you can't have his number.
Right. Well, gentlemen, thank you guys. It's an honor and privilege to hang out with you guys and have we love these conversations to really get business owners to really think about it and be really disciplined in approaching their once in a lifetime opportunity. As we like to say, if you're going to do this once in your lifetime, do it right the first time. So really take the time and understand why and who and how.
Yeah. Awesome.
Well, it is
perfect.
fun.
Perfect way to end.
Yeah, truly fun.
Excellent.
All right. Thanks. We'll see everybody the next time.
Thanks for spending time with us today on In Good Company. If today's conversation resonated with you, we hope it reminded you that you're not alone in the challenges and opportunities of running a business. These same conversations continue beyond the podcast, including at our In Good Company events, where business owners come together to learn, connect, and share perspectives. In Good Company is brought to you by Connecticut Wealth Management, where our mission is to turn life's aspirations into reality for our clients and team through connection, clarity, and thoughtful guidance. Until next time, thanks for being in good company.